I'm going to talk about a few different things today. I do want to give a quick supply and demand update. There was a new USDA report that was released last Friday that did end up providing some updates to estimates. And there's a couple of numbers that I do just want to quickly highlight because I do think it does end up giving an indication of what we can expect with old crop prices in particular. And so I'll talk a little bit about old crop prices. And then I do want to shift to the 2025 outlook. So looking at where input prices and what profitability ends up looking like for 2025, and then talk a little bit about new crop prices, and then close with just a couple of things that I think should be on everybody's radar from a policy standpoint. Obviously, with the new administration, there's still a high degree of uncertainty in terms of the direction ag policy will end up going, but there's a couple of proposals that are floating around that could be beneficial to a lot of the producers that we work with. And so when we look at supply and demand, I'm not going to go through all these different numbers, but there was a few things that I thought was important from the WASDE report that I think we really need to end up highlighting. The first one is that U.S. average yield, the national average yield, was actually decreased by zero point 0.7 a bushel, and it's within itself is not massive. But what I think it does do is it kind of sets a floor expectation when we're looking at what our total production is going to be in the U.S. Now, obviously, in Tennessee, we've got a very different set of circumstances depending on the area of the state we're in. We've got highly variable yields. In general, the yields to the east and to the south are substantially worse than those in the northwest. The latest estimate for Tennessee average yields is 153 bushels per acre, which is substantially down from where we would normally expect us to be, where we'd be up in that 175 bushels per acre area. But the good news on the national scene is that this kind of sets, I guess, an expectation of where production will ultimately be estimated for this year. The other big component that I want to point out on the corn side of things is that carryover stocks for U.S. Is under 2 billion bushels, which again should be supportive for prices. I'm not saying we're going to go to $6. What I am saying, it does assist in setting a harder floor in terms of prices, which I think is positive, right? We want to set that floor and hopefully end up having incremental increases as we move throughout the winter here. The last one that I'll point out on the corn side is that foreign stocks number. It was revised down a little bit, but the key point to me is if you look at that year over year change, which is this 575, that's a pretty substantial decline. Now, obviously, the elephant in the room as we move through the winter is going to be what's going to happen in South America, both on the corn and soybean side of things. So there is the potential to see revisions to that number. There were no changes for corn or soybeans in terms of South American production in the WASDE report. When we shift to soybeans again, I was looking at that yield data, and this one actually surprised me a fair amount. Average yield was dropped 1.4 bushels per acre, which was actually one of the largest drops we've seen in soybean yield for this month. There's a lot of speculation that because of the dry weather that we ended up seeing through August across a good chunk of production regions, that yield it may even drop a little bit more, which is a definite positive for securing a bottom to the price. Again, we do have to have concerns about that South American crop and where that ends up sitting, but it was overall a slightly bullish report when you consider all factors for soybeans and corn. Getting that ending stocks number below 500 million bushels is also another one that's very important. So again, I think what this has done is stabilize the downside of the futures market, which should allow us to end up potentially taking advantage of some upward price movements. When we look at kind of the year over year picture, this is where we're different than corn, right? If you look at where U.S. ending stocks and particularly foreign stocks are, if you think the corn number was negative, this one's positive, almost 600 million bushels plus what we ended up having in the U.S. So again, there are some limitations as to how far prices will advance without a production disruption, particularly to the south. Wheat, real quickly, I'm not going to dwell on wheat, but I do want to end up pointing out some of the changes. There's actually a pretty reasonable bullish argument that you can make internationally right now. The challenge with wheat, again, is that you have different categories of wheat, and that really matters. And so the key number that I'm looking at is exports, and I look at it in aggregate. But what you really need to do is you need to look at the export numbers based on the type of wheat that is being traded. And so when we look at spring wheat versus winter wheat versus hard versus soft, there's very different categories. And the big challenge that we're running into is there's certain parts of the world where there's lower quality wheat stocks, and they're going to be purchasing to end up blending away or to end up covering certain uses. And so the number that I'm going to continue to watch through the winter in terms of price direction is where that export number falls and how it actually impacts the different classes of wheat as we move forward. But when we look overall, that foreign stock number reduction of 438 million bushels, that should be a positive. The challenge with wheat is that it's grown on every continent besides Antarctica and both hemispheres, and so there's always a degree of production going on across the globe. So there can be the ability to end up just in those stocks numbers when you look at it in aggregate. And so again, it is important to look at the different classes when we end up looking at what's going on with the wheat circumstances. I did want to kind of do a quick update on where we are in terms of storage of old crop. And I just wanted to highlight the importance of looking at both the futures market and basis in separate increments. So if you look at the chart on the right, this is just the straight futures contract price for corn and soybeans by month. You get the price spread, and then you get the estimated interest cost at 8.5%, and it gives you an indication of, based on that spread, is it profitable to store corn and soybeans? Based on the futures market alone, the answer is no, not right now. The interest cost will actually exceed the price spread where we're at. But we have to factor in basis and basis expectations. And so this is going to vary depending on what part of the state you're in. I was looking at some of the ones in southern middle Tennessee where corn was 50 over the board and soybeans were 70 over the board. So that's very different than what's going on in West Tennessee. Again, there's a real regionalization to this with the lower basis offerings, kind of that northern middle part, higher basis offerings in that southern and eastern part. But it really matters what our basis expectations are. Most posted contracts go out until January or March in terms of what that basis offering is. So if you're looking to store beyond that, you have to formulate a basis expectation, and that'll dictate whether it's profitable to end up storing corn or soybeans and under what circumstances. When we look at futures prices, again, I don't think this has fundamentally changed. When we look at nearby futures prices, we're likely to move more sideways with slight seasonal increases as we move into the winter. I think what we'll end up seeing is trading somewhere in that $5.50 to $6 range more consistently on wheat. When we look at corn, again, moving sideways somewhere around that 440 range, we could bump up closer to that 460 range if we continue to get some beneficial news in terms of production down in South America and where our final crop estimates are in the US. But I don't see anything on the radar that would indicate that we've got $5 corn coming in the next few months. When we look at soybeans, a similar thing. This is one where there's probably more uncertainty in soybean prices than corn or wheat, just because of the importance of the South American production that will be mostly determined between now and January. And so again, you could make an argument that we could see lower prices if we see another record crop down south, or we could end up seeing a price rally if we do end up seeing drought or some other production disruption down there. So you have a little bit wider price expectation there, but I think again we'll be just on the north side of $10, somewhere 10 and a quarter to 10.75 is the most likely trading range right now when you look at nearby soybean futures. When you're looking at old crop marketing, I mentioned it, I think it's really important to disaggregate that price. The cash price is the price that we care about, but we really want to look at the futures price and basis separately and use different marketing tools to end up securing those prices. It gives you more flexibility and can be beneficial, particularly on the basis side. I think that's where we have the potential in Tennessee to really potentially get some additional sense into the pockets of producers. If you think about it just intuitively, and again, it's very regional, but basis is a reflection of local supply and demand. Now, there's limitations to it. You can't have basis run too far away from other markets, otherwise you'll get an influx of the commodity into the region. But given our short crop, particularly in the east and the south, I would expect that our basis should be much stronger than it was in 2024 in general. Again, it's gonna be variable, but I think there'll be opportunities to secure a stronger basis. Futures might appreciate marginally, but I think basis will be where we can get some work done for a big chunk of the state. One thing that I do caution people is just throwing a commodity in storage and holding it and hoping for better prices is not a great pricing strategy. I think you can open yourself to undue risk. So one of the things that I do like doing is securing a futures price, and it doesn't have to be locking in that futures price. You could end up doing some type of options fence where you're looking at securing a floor and foregoing maybe the top side of the market, but locking in a price ranger I think is good. There's several strategies that we can end up utilizing to end up doing that. You do have to factor in those interest costs. We have seen interest rates come down the last couple of months here, and it's anticipated that we will likely see them slowly come down a little bit more in 2025. A lot of that going to be dealing with inflation. But again, when we're storing and we've got an outstanding operating note, we do have to factor in that interest costs. When you're looking at corn and soybeans, even at current levels, it's somewhere around 3 cents a month for corn and 7 cents a month for soybeans to end up holding that commodity in storage. So that needs to be factored into our marketing decisions. I think you need to be selective when you're looking at pricing those commodities that are held in storage, particularly on the basis side. This is one that I end up looking at. This is the monthly index that USDA puts out based on crop prices received and paid. So how much is going out versus how much is coming in. And I think the important factor here, and I'll talk a little bit more about inputs as we look at kind of the 2025 circumstances here. But you can see what we ended up seeing was that dramatic run up in input prices and then the run up in commodity prices. Well, commodity prices came down, but what we've seen is basically a flat line, maybe down a little bit from the highs, but moved mostly sideways. And so again, when we think about this in terms of how it affects our producers, is we look at margin compression, right? You're going to end up having high input prices with lower commodity prices. And again, that's going to end up affecting what the margin that producers are receiving. When we look at land prices, this was released. I don't put a whole bunch of stake into what these individual numbers are. What I do like looking at is that trend where we had a 10.7% increase from 2023 to 2024 in the price of farm real estate in Tennessee. When you look at other areas of the country, that is one of the higher numbers in terms of annualized growth. When we look out to 2025, I don't think we're going to be at that 10 or 11%, but we will still have a very strong land market because a lot of our agricultural land is not dictated by production value. We have people that are purchasing land in the state. So I anticipate that market to remain up as we move into 2025 with increased values. When we look at cash rental rates, those have come up. I think we could end up seeing those not come down, but to end up at least move sideways when we have these lower commodity prices. When we look out to 2025, this is a monthly chemical index, and I guess the takeaway on this is when we look at where we were, we've seen that run up in chemical prices around 2022 and 2023. We're down off those highs, but we're still at elevated levels relative to where we were prior to 2021. When you see fertilizer prices, similar set of circumstances where we're down substantially from the peaks, but we've kind of been moving sideways. Some fertilizer prices have actually upticked a little bit. And so it'll be interesting to see if we've set a firm bottom in fertilizer markets or if there will be further movement. The greatest probability right now, I think, is a mostly sideways movement in fertilizer prices, but we'll have to wait and end up seeing how prices react as we enter the 2025 production year. Similar thing for diesel prices. When we look at, again, where we peaked and we're down from that, but we're still at elevated price levels. So when we're looking at input prices, I think land and cash rent is going to remain high. It's going to be high for 2025. There will be opportunities to potentially purchase machinery and equipment, but it depends on what you're looking for. I think there will be the potential, particularly on the row crop side, to really get some potential good deals on that. When we look at inflation, I think interest rates will end up continue to come down as long as those inflation numbers end up continuing to stay somewhere south of 3%, hopefully closer to 2%. The one that I'm really looking at to dictate that inflation level is what's going on in terms of energy prices and geopolitics. I think is going to play a really important role in 2025 in terms of what occurs on the inflation front. When we look at 2025 profitability, this is just some initial estimates with a return to trendline yield in Tennessee, some price expectations based on where we are in the futures market right now, and then a cost structure where we're slightly down from where we were in 2024, but not substantial declines. What you'll notice is when we look at the returns over the specified costs, we still have some real challenges in terms of profitability with break-even prices higher than what the market is offering for 2025 at this juncture. A lot can change between now and when planting occurs, but where we're at right now is not looking like we're going to have a super profitable outcome for 2025. And so again, what we need to make sure we're doing is really managing those expenses and looking for opportunities that we can end up getting a higher output price and managing that risk. When we look at what the futures market is telling us, the lower price environment is likely to persist unless we see something change, particularly down in South America. When we're thinking about reasonable price expectations, corn prices between $4 and $4.80, wheat $5.30 to $6.30, soybeans $9.75 to $11, and cotton 67 cents to 76 cents. And you can see when you look at the deferred contracts that are out there, there's a real I guess kind of a clustering of where the futures market is telling us where prices are likely to end up trading. Again, it can change over time, but I think we can end up reading into this that there's not a huge carry in that market. When we look at basis, again, it's always challenging talking basis in Tennessee because it's very different depending on what part of the state you're in. But I did want to talk about the differences between 2024 and the 5-year average. And again, when we think about that 2023 crop, we had a really good crop in Tennessee. In 2024, we'll have a poorer crop. So again, I think that should help facilitate a return to a stronger basis offering for both Tennessee, for both corn and soybeans as we market the 2024 crop. When we're looking at new crop marketing, again, I would look at futures prices versus basis. I think we can preach some patience right now. I wouldn't rush into 2025 pricing decisions. I think you need to end up considering where you are, look at your cost of production, understand some of the price trends that are out there, and formulate some market expectations. The big one to me to prepare for the 2025 crop is to look at what different pricing alternatives work well in the market that we're entering. And I'll talk real quickly about what that looks like. But having that patience and looking at pricing incrementally across the season, I think is going to be really important for 2025. So maybe doing a small percentage pre-planting and then doing some in-season sales, harvest sales, and then have an understanding of what you can carry into storage and price throughout the winter. So when we look at the pricing alternatives that we can do, there's a couple of things that I want to point out, and I'll show all three charts for corn, soybeans, and wheat, but they're all very similar when we look at pricing behavior during certain market conditions. And so when we think of the years 2015 to 2020, what we had was low prices, but we also had low volatility. And so you would use very different marketing tools in a low price, low volatility environment than you would say in 2010 to 2013 or 2021 to 2023, where we had higher prices but higher volatility. And so you have to think about what marketing tools work well under the market conditions that we're likely entering into in 2025. And what we're indicating right now, and things can change obviously, but we're entering a lower price environment where we're probably going to have lower levels of volatility. And so one of the things that we can think of is how do we use that to end up looking at setting a price floor and or foregoing some of the top side of the market as a way to end up augmenting any costs associated with using certain risk management tools. Similar thing in soybeans. Soybeans, obviously, we do have a little bit more volatility than corn, and that's just a function of the fact that there's really only 3 countries that matter in terms of the production of soybeans. US, Argentina, and Brazil. And so if we do see a disruption in one of those countries, it has a greater impact than, say, if we have a disruption in corn. But again, you see a similar pattern where you enter a lower price environment, it decreases the volatility, and you want to end up using that to formulate your expectations and to look at the tools that you would utilize in marketing the crop. When we look at wheat, wheat was a little bit different, but it shows a similar pattern. When we see this big spike, that was a direct result of the Ukraine Russia war being started. We see prices just explode to the upside. Other items before I turn it over to Andrew that are on my radar: ad hoc payments to crop producers due to declines in prices. There's a lot of chatter of something coming out of Washington D.C. to help support crop producers. There is an act that's out there, the Farm Act. Logan sent me an interesting article on that where there are prices that are defined for corn, soybeans, cotton, and wheat. The structure of it is basically getting payments on a per acre basis based on national data in terms of production costs and estimated revenue. And some of the prices are pretty substantial, or some of the payments are potentially pretty substantial. We still have to wait and see whether that will end up being passed and what any modifications would be on there. The second one is a new farm bill. There's a couple of proposals that are out there. I think given the results of the election, I would say that there's maybe a 30% chance that we have a farm bill completed in the lame duck session, with a 70% chance of doing it after we get the changeover. There are some incentives that are aligned to end up pushing the farm bill through before we see the changeover. If you think about it, both from a Republican and a Democratic side, when you think about the Republicans, if they can pass a farm bill, it allows them to start with a clean slate and advance maybe more higher priorities in terms of their agenda. From the Democrat side, because they still have control over the Senate, they can maybe end up using that to negotiate a few things in the farm bill that they are hoping to end up accomplishing before they lose control. So again, I think there's about a 30% chance that we get a new farm bill before January. And then if not, it'll obviously open it up to further negotiations and could change. But some of the important features of what we've seen in terms of potential new farm bill that are important to Tennessee producers. The first one is increased base acres. I'm sure many of you have heard me kind of beat this drum, but we have a lot more planted acres than we do base acres. Some of the proposals have a mechanism to end up increasing the number of base acres that we get payments on. That would be very beneficial to Tennessee. The other one is the update in reference prices. Obviously, when we started Arkin PLC back in 2014, we were under completely different market circumstances and cost structures. The reference prices have not caught up or kept up with current market conditions, and so there's proposals to end up increasing those prices to reflect where we're at. There are some proposals to end up doing some crop insurance modifications. Most of that revolves around adding additional commodities and potentially modifying the subsidy levels. I also do think that there will be a greater emphasis on some of the companion policies that are out there. So if you think of SCO and ECO, I think they'll try to expand those products to provide additional coverage to additional counties and commodities, so that there's an additional risk management tool in the toolbox for a lot of our producers. So with that, in summary, when we look at input prices, they're most likely to move sideways. I'm really interested to see what energy prices do in 2025, because I think that's going to be the key to maintaining inflation near that 2%. If you bring down the energy costs, you can still have a very robust economy without end up having substantial levels of inflation. When we look at our key commodity prices, they're likely to remain low in 2025. So it's going to be very important to use our marketing and risk management tools and making sure that we're really sharpening our pencils and knowing where we are in terms of a cost of production, so that we can end up looking at opportunities that are profitable if they are presented during the year. I would have an old crop marketing plan for any crop held in storage. Holding crops in storage, particularly on the futures side, unpriced, there is some risk that is embedded in there. So I would be cautious with that. I think it's a safer play to end up looking at securing some price protection on the futures market and allowing basis to do some of the work. That being said, if there are good basis opportunities where you have producers that are comfortable in taking that 50 over or 20 over, depending on where your location is, I would definitely end up considering locking in that type of basis. If you can get a futures price for say March in that 440 range on corn and lock in a positive basis, you're getting pretty close to $5 in some circumstances. So again, looking at those opportunities, I think are really important. And again, when we look at kind of the policy environment, we're likely to see some pretty substantial movement over the next 6 months, but it's highly uncertain as to what will emerge. And so we'll have to stay tuned to that. With that, I'm going to stop sharing my screen